Welcome everyone to the Land and Everything podcast. Today I am being joined by Steve Bruere, who is the CEO of People's Company. Steve has joined us on the podcast before, but I'm excited to get to have him again to kind of have a little bit more of a deep dive conversation into the institutional ownership of farmland. Steve, thank you so much for being willing to join us today.
Yeah, always enjoy visiting with you. Thanks for including me.
Yeah, great. So before we get started, Steve, we've already introduced you, but maybe for people that didn't maybe listen to the first episode, can you just give us a real quick background on you and a background on People's Company?
Happy to. Yeah, I'm an Iowa farm kid. My family farms here. My dad and brother still farm together south of Des Moines, corn and soybean operation. And I got involved with People's Company right out of college back in 2003. So I've been in the real estate business for about 21 years now. And People's Company now works across 30 states in the U.S. and anything that involves a farmland transaction, we touch it. So we manage farmland, we appraise farmland, we auction and sell farmland. We've got a capital markets group that deploys capital into farmland for high net worth individuals and institutions and others that want to build farmland portfolios. And then we do some work in the energy management space as well, oil and gas and renewables. And so anything that touches a land transaction, that's the kind of work we do.
Awesome. Yeah. And geographically, where all are you guys located?
Yeah, we've got offices strategically placed in all the major agricultural regions in the country. So our core operation is in the Midwest, and that's where our home office is in Iowa. But we've got offices up in the Pacific Northwest that serve that region, a couple offices in California that serve California and Arizona, a few offices throughout the Delta region that serves the Mississippi Delta, an office up in Michigan that serves the Lake States, and then several offices throughout the Midwest.
Awesome. Great. Well, I asked Steve to join us today because Steve has a really great perspective on just the institutional ownership of farmland and how it's evolved, particularly over the last 15 to 20 years. And so I wanted Steve to kind of give a little bit of a background on just the history of investing in farmland, how it became kind of this asset class, particularly over the last 3 to 4 years when we've seen land values, going up 20, 30, maybe even 50% in some areas. So excited to get to talk to you a little bit about, why that has happened, kind of the evolution of why people are interested in investing in this asset class. So before we kind of talk about current trends, let's kind of go back in time a little bit in history. And let's talk about prior to the Great Recession. So we're going to kind of structure this discussion on before and after the Great Financial Crisis in 07, 08, because that was kind of a pivotal turning point in agricultural investment. So talk to me about kind of who were the early investors in farmland, who were those groups and kind of how has that evolved, maybe how that evolved pre 2008.
Yeah, so I started my career in farmland in 2003, and I joked around. I used to go to the family holiday parties, and you've got the heart surgeon or others in the family that you're trying to talk into investing in farmland. And back in that 2003, 2004, 2005 period, there just wasn't a lot of interest in farmland. It wasn't an asset class that was deemed investable by a lot of people, and there weren't options to get into farmland. And of course, there were some institutions that were in farmland. The Westchester Group that Murray Wise started, that's now part of the Nuveen investment group. Manulife. There was some early institutional capital that was in farmland. Some of that came out of the 1980s farm crisis and then morphed into asset managers that were actively deploying capital in farmland. But a lot of the investors that are in the space today didn't exist prior to 2003. There's been a lot of capital that has moved into farmland over my 20-year career. And I would say observationally, that 2008 financial crisis was really a turning point. That's when we started to see a lot of outside capital show interest in getting into agriculture and into farmland. And of course, at the time, we're always biased and we've always thought farmland was a great investment. But it was interesting to watch the rest of the world discover it and start to develop theses around investing in farmland. And looking back, of course, now we understand with quantitative easing and what happened with the monetary system. There's just a lot of capital chasing yield and looking for alternative places to invest capital, and farmland really became the darling for a lot of folks coming out of that 2008 financial crisis. And we started to field a lot of phone calls from folks on the West Coast, East Coast that maybe knew nothing about agriculture, nothing about farmland, and wanted to start getting some exposure to it. And there wasn't a lot of vehicles to do that. If you did talk to a lot of those bigger asset managers, they're making investments in the 50, $100 million range, or taking capital allocations, I should say, in those larger chunks. So if you were a private investor that wanted to put $5 or $10 million into farmland, there just wasn't a great vehicle for it. So that was kind of the beginning stages, I think, of folks coming in, and you started to see conferences sprout out. We hosted one, the Land Investment Expo, that annual conference that we started hosting in 2008. Probably the most well-known conference around this topic is the Global Ag Conference in New York, GAI, that started in 2009. And you started to see a lot of investment theses around growing populations, rising income, global demand for food, fuel, and fiber. And that was real. The numbers were real, but I think looking back, what spurred that interest was what I'd mentioned: quantitative easing, capital that was looking for a yield, maybe some diversification from other asset classes, and that's really what spurred that initial interest in farmland.
Yeah, when we talk about, quantitative easing and what was happening in 07, 08, the Federal Reserve dropped interest rates essentially to zero, and then they were expanding their balance sheet so much so that they could lower those long-term rates and trying to boost, lending and economic development. And as a result, people that looked for, treasuries and maybe other fixed income assets as an inflation hedge and also, a way to diversify their portfolio against equities, a little less volatile, really started taking an interest in farmland. And you and I had this conversation a few weeks ago, and I loved your point where you said they fell in love with farmland because there just wasn't anything else to fall in love with at that point in time, which I think is really interesting.
Yeah, and you saw that, just even local investors, and I mentioned the family holiday parties. You just started to see the sentiment change overall because you looked at farmland, and yeah, the cash yields were low, maybe 2-3%. But the alternative was to put it into equities, which a lot of folks are overweight equities, or put it in a bank and basically get a zero yield on your money market account. And so farmland with a 2 to 3% return with some inflation adjusted appreciation built into it really became a highly desirable investment for folks. So not only did you have that underlying thesis of growing populations, rising incomes, demand for food, fuel, and fiber, but you also got a current cash yield and you got appreciation. And so it was an easy sell, frankly.
Yeah, absolutely. Yeah, when we look at the long term return history and just risk profile of farmland, it demonstrates a higher return than equities, around 10%. And that can be even higher depending on where you're investing, and a fairly low standard deviation of around between 5 and 6% compared to a very, double or triple that when we look at equities. And so it really can be a very, very good risk hedge and also an inflation hedge. We haven't quite touched on that yet, but, has a long-term positive correlation with farmland, or inflation has a long-term correlation with farmland, which we've seen even over the last couple of years as well.
Absolutely. Yeah. I mean, it's not correlated with the stock market, and it's positively correlated with inflation. And that's why it's such a great diversification for folks. And that's why I'm a big long-term believer. I think anybody who's got any, net worth at all should have farmland as part of their balance sheet. And again, there's just not a great way for folks to get access to it. But now we're moving into a new environment where now some of those money market accounts and T-bills and bonds are paying a higher yield. And you mentioned it. We've gone through an inflationary period, and we all believed farmland was a great inflationary hedge. And it proved out it is a great inflationary hedge. We've got to see it work real time, and the thesis has been tested.
Yeah. Yeah. So let's talk a little bit kind of in the past, 15 years. So we had a lot of funds that started up after '08, let's say in that 2010 to 2011, maybe 2012 time frame. And then they would have had maybe a life of 10 years. Take me through, those 2010 era in agriculture. What did that look like? And what kind of impact did that have on farmland?
Yeah, it definitely brought a new audience. A lot of the farms that we historically sell, you sell to farmers and local investors. And you started to see a lot of new funds get started. And as you mentioned, a lot of them would be a 10-year fund that would have some sort of success fee built in based on a IRR hurdle of, say, 7%. And so, the fund managers were very motivated to deploy capital and very motivated to achieve returns above a 7% IRR, broadly speaking. And what's interesting about that is going back to your cash yields being 2 or 3%, and your hurdle rate to get your success fee, is in that 6 or 7% range. The early institutions realized, hey, we've got to create superior appreciation on these assets if we're going to perform something beyond just the cash yield. And that's why folks want farmland. And so, it was interesting because there's folks that came into this that did have some agricultural background and had great ag experience. And then there was a whole lot of people that, would start calling the office. And as I'd say, New York based, Boston based, San Francisco based. And, we'd get those phone calls. Hey, we've got, a new fund. We've got $250 million. We want to buy large contiguous tracts of land. We want high quality land. Looking for tracts that are underpriced. Want to achieve a high cash yield, and we used to joke around that when that call would come in, it's like, yeah, you and everybody else has 250 million. Because there was just the floodgates kind of open. There was a lot of capital flowing into agriculture and into farmland. And again, coming out of that '08 financial crisis, looking for yield, looking for a story, looking for diversification. And so we were happy to take those phone calls and help put people into farmland investments.
Yeah, we haven't touched on this yet, but that is kind of the hard thing is you had so much money chasing a fixed asset class where there is quite a bit of farmland out there, but it doesn't change hands every year. They say estimate around 1 to 2% changes hands at an arm's length every single year. And so you had a lot of capital trying to chase an asset class and not a lot of asset class available to these institutional investors.
Yeah, that's a real problem. I don't think a lot of folks understand the challenge of getting access to land. And 1 to 2%, as you say, hits the public markets on an annual basis. And when you look at our sales data over 20 years, 70 to 80% of the farms we sell to farmers. And so when you think about all the outside capital that came into farmland and was trying to compete against farmers who also want to own farmland, and it's such a thinly traded market to begin with, there was a lot of dollars chasing really very few deals. And so it was a pretty interesting phenomena.
Yeah, and even when we look, I know there's been concern among people that, there's all these institutions coming and buying farmland, like what is left for the farmer? And in reality, the amount of institutional ownership really low in the United States. It's somewhere around 4%. And even then, I mean, as you know, Steve, a lot of these institutions really are in a partnership with their farmer partners, as I know you guys try to foster that partnership.
Yeah, I always, and again, being a farm kid and and really early on, what triggered a lot of this was within my own family's farming operation, and kind of why we started paying attention to this. My brother farmed several thousand acres, and every year there'd be a few farms that would come up for sale in his operation. And he'd call me and say, hey, this, farm came up for sale. I don't have the capital to buy it. Do you have an investor that we could put into this deal? And I always joke around that farmers don't like investors unless it's their own investor that they can use in their operation. But when you look at the demographics of who owns farmland, and in Iowa, as a for instance, I think 60% of the land in Iowa is owned by somebody 65 or older. And we've got great data in Iowa, but it's pretty consistent throughout the entire country, those types of stats. And so, when you think about young farmers who are putting their capital into their farming operations, grain setups and their shops and their farm equipment and their technology, the capital required to do that is substantial. And so having that outside capital that can participate in the farmland transaction, it's a win-win, and it's a good business model if you have the right kind of capital who has the right alignment with their farm tenant. And so, yeah, we've been really active connecting farmers with capital my entire career, and have really built a nice business around doing that.
Yeah, that's awesome. I think they can, these institutional investors can really be in a true partnership with their farmers and with the farm operators, and can give them optionality maybe to pursue other projects, maybe have a little bit more leeway to pursue, maybe some more conservation friendly practices or sustainable practices that the farmer themselves, just because there's a lot of times spread so thin, wouldn't have that ability to finance those kinds of projects themselves. And so they really can, especially when we move into this era of, climate smart agriculture, and also this idea of, reducing our carbon footprint. Agriculture really can be a key to that as well.
Yeah, it definitely is. And I think about some of the transactions we completed. I think there's a perception that investor capital is bad if you're not within agriculture. And I joke around. I've looked for dumb money my whole life, and I've not been very successful at finding it. Like the investment capital that's coming into farmland is it's sharp, it's sophisticated, it's smart. There's mandates around what they're trying to do. A lot of it is around ESG. And so I don't see that outside capital coming in and really driving up prices for farmers. I think it's more complementary. But there's certain areas where institutions can buy farmland, and then there's a lot of states where they can't buy farmland, and that's a lightning rod issue right now in Iowa. It's Chapter 9H of the Iowa Code that prohibits corporations from having direct or indirect ownership in farmland. And I think it's 13 states now in the country have some sort of corporate ownership ban. And of course, now there's a lot of issues around foreign ownership that are being debated that are going to make this a big issue over the next several years going into the Farm Bill.
Yeah, no, I agree. We had a conversation with Dr. Bruce Sherrick kind of about this foreign ownership piece, and about just the structure of ownership in the United States. I think it's going to continue to be a concern. But when we look at even foreign ownership, it's a very, very, like, less than 1% is owned by foreign investors. So let's talk a little. Oh, sorry, I was interrupting
Yeah,
you.
and then a lot of that's timber
Yeah,
and non-agricultural land and whatnot. And I think the China story gets
yeah,
overblown too, because what are they, like number 17 on the
yeah.
list
It's
of
very small.
foreign owners? So, yeah.
Yep. So let's kind of talk a little bit more about what we've seen in the last, 3 to 4 years. So a lot of these funds, like we talked about, had a life of 10 years. And so a lot of them came due in 2021, 2022, maybe 2023 even. Um, is the institutional capital chasing farmland again? Are they, interested in, starting maybe another fund? What are you seeing in your day to day on that?
Yeah, that's a great question. There's different styles of capital out there. You've got capital that's probably more permanent and more committed and has been in farmland. We touched on a few of those early with Manulife and Nuveen and that style of capital. But then there's a lot of the funds that were relying on some of that money that was chasing yield and just looking for a place to put capital when money was free. And I think now that there's alternatives, we heard that a lot last year. Again, even from private investors, And I got tired of having this conversation. But why would I buy farmland and get a 2-3% return when I can go get a T bill for 5.5? And it's like, well, if you look at the 20-year appreciation rate for Iowa, Illinois farmland, it averages close to 7%. And if your cash yields 3, 7, you got 10, T bill 5.5. I know which one I'd rather own. And I always tell folks on the T bill, you can't 1031 exchange it. You really can't go to the bank and add leverage to it. You're not going to get a surprise letter in the mail that there's a wind project or a solar project or a battery storage project or a data center project. And so, but because the cost of capital changed, it's definitely having an impact on the appetite of investors that want to come into farmland. Because for 20 years, the conversation at the kitchen table was, if I sell my farm, where would I go and put my capital? Well, now there's places to go and put your capital if you sell your farm. But if you are looking at those same alternatives as a buyer, you might say, "Hey, I'd rather be more liquid and be in a bond or a money market account or a T bill or whatever it may be." And so there's definitely been less capital chasing farmland going back in the early part of 2003, and I think that's still the case here in 2024. But when you look at that farmland inflation chart and understand how positively correlated farmland is with inflation, when CPI was running at 7 or 8% last year in 2023, I'm like, bring it on. The more inflation, the better farmland's going to do. And that's true until a point.
Mhm.
And then, once you get interest rates to a point, that's what we saw in the 1970s and the 1980s. I think the average acre of farmland in Iowa in 1973 was around $600 an acre. And by 1981, that had gone up to something like
Yep.
$2,300 an acre. And of course, Paul Volcker comes along, takes interest rates up above the rate of inflation. And by 1987, that same acre of farmland went down to somewhere around $800 an acre. And so inflation's good for farmland until it's not. And then once that interest rate gets above your inflation rate, then it can cause some damage. And so, that's really what I've been trying to think through and figure out is, where are we at? Are we closer to 73 or 81? And as folks are looking at farmland, is now the time to get into it. And, I guess that's really a question of, where do you stand on inflation? And do you think that the Federal Reserve solved our inflation issues, or are we closer to 73 and there's more persistent inflation? And I guess what my observation is, farmland is built to be owned in an environment where you have inflation, and it sure feels like inflation's much more persistent than a lot of folks maybe had thought a year ago at this time. And so that's the dynamic. That's what people are thinking about.
Yeah, and anytime, where we think about where inflation stems from, obviously there what we saw in COVID, supply chain backlogs, but it's also can be really impacted on government spending. And considering we have an incredible deficit in our budget currently, I don't anticipate inflation to go away anytime soon. I think, we're in a period right now where it's, returned maybe to maybe more manageable rates. But even when we look at the year over year inflation, we're comparing numbers that where we saw rising inflation of 7, 8%. And now we're saying, oh, well, it only grew 2% year over year. And yet it says yes, but it's already on top of really high inflation, what we're comparing it to.
For sure, for sure. And I don't know if I fully answered your question, but my friends that are on the capital raising side, on the farmland side, I mean, that's the battle that they're fighting right now, is getting folks that want to put capital into farmland. And so some of those 10-year funds, where maybe they heard about farmland in 2008, they launched their fund in 2010, started deploying capital in 2011. A lot of those funds were 10-year funds. And so, 2021, 2022, you started to see folks that were buyers start to become sellers. And, that's pretty traditional. But then you'll usually launch your next fund as you're selling your first fund. And that's where you hit that headwind of, okay, we're trying to sell current assets, but we're raising money for new assets, and it's a new ball game because the cost of capital's changed. And I think the fundraising has definitely been more challenging in the current environment. And yet the thesis for farmland's never been stronger, right? Inflation hedge, not correlated with public equities. And so it's going to be interesting to see who's committed to their farmland strategy moving forward. I think there'll be a little shaking out for sure. There's going to be some folks that got into it because it was, because quantitative easing made it easy to be in farmland. But it'll be interesting to see which groups are here 5, 10 years from now.
Yeah, so on that point, particularly Steve, there are groups that are getting out of farmland just because of the, asset management side. It is a pretty, I don't want to say intense. There's a lot of management that goes on when it comes to owning farmland. It's not, especially in this day and age, it's not just as simple as finding a tenant to rent your land to. A lot of these institutions also have, maybe ESG initiatives. Maybe they're pursuing capex opportunities on that farm, and so you really need to have a strategic partner that can really manage that asset effectively for you. And I know that's something that you're seeing even in your day to day, especially as you are, a strategic partner for a lot of these institutions.
Yeah, I think we're managing farms now in 25 states across the country, and so you get exposure to a lot of different asset types and classes and strategies, and some that are custom farming, and some that are direct operations, and permanent crops and row crops, and organic and regenerative, and then there's so much happening in renewables now with carbon and wind and solar, and so there is a lot that goes into it, and the attractive thing about farmland has been, it's got a zero vacancy rate, right? You've got this underlying crop insurance system. 90% of the acres in the US have a minimum revenue guarantee. So if you go buy farmland, lease it to a farmer, you're going to get paid your rent. It's protected by crop insurance, no vacancy rate, and rents are going to go up because commodity prices have been going up, and cap rates have been compressing, and therefore, there's been a lot of folks that have been really successful in the farmland business the last 10, 20 years. And that's what I always tell people about my career. It's been pretty easy to be in the real estate business when every year of your career, the cost of capital gets cheaper. And now that we're in an environment where the cost of capital is pretty expensive relative to what the returns are in farmland, you've got to get a lot more creative on your asset management strategies. And if you're borrowing money at 7.5 and you're getting a 3% cash yield, then you've got to figure out how you're going to bridge that gap somehow, some way. And I think that's my observation, is it's going to be really interesting to see how these asset managers go about managing their assets when you've got to really roll up your sleeves and get really creative with your farming strategies to get that additional return squeezed out of the asset.
Yeah, no, I don't want to say it was easy the last few years, but naturally, because of the way the market was going, it was easier to obtain, stronger returns just because of where markets were. And now I think within the next few years, we're already starting to see transactions slowing. And I think within the next few years, it's really going to be, the people that really want to roll up their sleeves and get dirty in the farmland. And otherwise, you're not going to achieve those returns. You're really going to have to buckle down and, think about those improvement projects, think about opportunities maybe in wind, solar, carbon storage, the renewables space, if you really want to be successful.
Yeah, I think that's right. And last time we went through a commodity price cycle, 2010, 11, 12, I think land values in the Midwest peaked in 2013, and commodity prices softened. And a lot of folks thought, okay, well, commodity prices are softening, the land market's going to soften. And it did, but not to the
Yep.
degree that a lot of people thought. And the example I always shared with folks, if you lowered your rent on your farm by $50 an acre, but you lowered your return expectation by 50 basis points, you compress that cap rate, your farmland value effectively stays the same. And that goes to my point of my career. As the cost of capital has gotten cheaper, it does tend to make you feel really smart. But it's just the financial markets that are, the wind in your sails that are really helping you out. And now we're going to unwind
Mhm.
that cap rate compression, and so it's gonna be really interesting to see how the asset performs as you're competing against that higher cost of capital.
Absolutely. Well, last question on this, and I'm gonna ask you to take out your crystal ball a little bit. What do you think long term outlook for farmland is? Obviously you work in farmland, so I'm gonna guess you're bullish. But kind of, what are your expectations, maybe over the next 5 to 10 years?
Yeah, great question. Crystal ball has been consistently wrong my entire career. I've always felt farmland every year of my career was too high. Like this is going to be the
Yep.
year that the market corrects. And for those that have bought farmland, they understand that the day you buy it, it always to buy farmland, and this comes back to that 1 to 2% hits the public markets. To get your hands on a piece of farmland, it's hard to do, to have the boots on the ground and the ability to get access to it, and that farmer who locally has the insight to get it bought. It's a challenge. And we had a really sophisticated high net worth investor tell us one time, hey, I love buying land in expensive land markets. And I'm like, well, explain that to me. And he said, these are generational assets that are selling, and people um, generally don't want to sell their farm unless they have to, either a divorce situation or a bankruptcy situation or an estate issue or whatnot. And in land markets that are incredibly strong, people will sell assets that they otherwise would have held on to for generationally. And so their thesis was an expensive run ups in the land market, high prices. They will have access to land that they otherwise wouldn't have access to, and they'll overpay. And the idea is, 10, 15 years from now, it won't matter if they overpaid, by a couple $100 an acre, because the long-term fundamentals in farmland are really consistent. And I thought that was interesting insight. There's so many folks that want to time the market. And if I would have used my crystal ball the last 20 years, I would have missed every one of these big run ups, because you don't know what's going to cause them. It's hard to anticipate the Trump trade wars that
Mhm.
generated market
Yep.
facilitation payments, and it's hard to anticipate COVID that generated COVID payments to farmers, and it's hard to anticipate Russia invading Ukraine. So there's so many factors that drive the farmland market. And what I do know with certainty is that it is not correlated with public equities, and that it is positively correlated with inflation. And the entry point's largely irrelevant if you're looking at it as a long-term investment. And so what I tell folks is, if you're committed to farmland, just get in and get some exposure. And I had some clients last week. I asked the question: if I sold you guys a bunch of farmland and it went down 30%, would you be happy or sad? And they thought about it for a second, and they're like, well, I think I'd be happy. I would buy more. And I think that's the key is, farmland should be part of a long-term strategy for anybody who's got any sort of balance sheet or any sort of wealth. And just being in the farmland business and watching how it performed over the last 20 plus years, um, you know, there's going to be cycles that, values come off. I think in Iowa, Realtors Land Institute is showing 3% lower year over year right now. It's a great buying opportunity. It's a great time to get in. And so what I've been telling my clients is that I'm completely confident with absolute certainty that any piece of farmland you buy today will be worth more 10 years from now than it is today. But I'm also confident that somewhere between now and year 10, there will probably be a dip in the market where it might come off a little bit in value. And if it does, then pick up a little bit more when that happens. And so I'm incredibly bullish. And I think a lot of the things that we mentioned, ESG, wind, solar, carbon, I don't think that's fully priced into the farmland markets today. I think there's there's so many opportunities where you look at the studies around getting to a net zero economy, and you can't do that without farmland. It's going to require incredible amounts of solar and wind to get there, and I think we're just on the beginning stages of understanding what the value of carbon is, and all of that requires farmland, and so I don't think that's priced into the market today, and I think those are the things, the optionality. When you compare farmland to a bond, when you buy a bond, you know what you've got, and it's not going to be anything other than a bond when you get done with it. When you buy a piece of farmland, you've got bond type yields, plus you've got all that inflation protection and all that optionality around additional revenue sources that maybe you didn't anticipate when you bought the farm. And so I'm incredibly bullish long term, but I do think we'll likely see some softening at some
Yep,
point.
I would tend to agree with you. We kind of forget to touch on this part, but food is a strategic resource, and it's going to continue. Our food supply is just going to have to continue to go up, and in combination with the energy space and the renewable space, I'm also very bullish in the long term for farmland, just because I think it could be the answer for a lot of issues that may come up in the future.
Absolutely, and the other piece that doesn't get talked about enough is the non financial benefits too.
Hmm.
And I think we saw that during COVID. The idea that I can own a piece of farmland and I can walk on it, I can hike it, I can hunt it, I can fish it, I can grow food on it. I think that's a big thing, that the non financial interest, and I think you look at a lot of these lifestyle buyers that buy trophy ranches and whatnot that have zero return, but they appreciate those non-financial benefits, and I think that's oftentimes not understood completely either.
Yeah, I mean, you and I come from a farming background, and so you and I recognize, the importance, and just from a psychological perspective, the tie that a lot of people have to land, and it's completely understandable. And so, yeah, that's a good point. We forget to kind of touch on those benefits that farmland can also provide to people.
Absolutely.
Awesome. Well, Steve, this was an awesome conversation. I just really, really appreciate your time. Can you tell our listeners maybe where they can find you, where they can find People's Company as well?
Yeah, we've got a great website. It's peoplescompany.com, and you can read about the various regions we serve and the offices we have around the country. We've got a great tool on there. That's our Farmland Insights tool. So if you get on People's Company and look up that tool, we've got a lot of the historical returns for farmland around the country, broken out by county, state, region. And we've got our National Land Values Report on there that summarizes the USDA data and the NACREIF data for all those regions around the country. And so a lot of good information on the People's Company website. And you can give our office a call, and anything that touches farmland, we're
Yep.
involved.
Yeah. Highly encourage our listeners, if they haven't gone, to check out the Land Investment Expo that happens every January in Des Moines, that People's Company puts on. Usually very, very good conversations around, the geopolitical issues associated with agriculture, as well as long-term land outlook, and other, ad hoc things that are really true and relevant to today's time. So awesome. Well, thank you, Steve. We really appreciate your time.
Yeah, thanks for including me.